Hi everyone, welcome back to my YouTube channel. This is Raz, and in this video, we will continue our discussion about losses. If you're ready, let's start. We have already discussed what is a loss, and we have already discussed the treatment for losses arising from casualties and the losses arising from operation. We have already discussed NOLCO. So in this video, we will discuss the losses arising from wash sales, abandonment losses, and the losses arising from gambling. Okay, so we have discussed these two losses already in our other two videos. So we will discuss these three other losses in this video. Okay, so let us begin our discussion by asking, what is a wash sale? A wash sale is whereby a non-dealer of stocks or securities or simply an investor sells identical stocks or securities of the same issuing corporation, resulting to a loss, thereby washing out or eliminating the taxable income, thus avoiding the payment of the tax. So when we say wash sale, this is a sale of securities or stocks by a person who is not a dealer of stocks. The primary objective or goal of wash sale is to eliminate incomes, okay, to avoid the payment of the tax. So the taxpayer who is not a dealer will sell its shares of stocks at a price resulting to a loss, and then acquire another the same stocks, identical stocks from the same issuing corporation. This is considered as a wash sale to eliminate the taxable income. When we say identical stocks, these are those shares of stocks or securities of any corporation having the same rights and features. So one of the many schemes of the taxpayers to reduce their income taxes, to reduce their incomes, is to have a wash sale. This wash sale is, by the way, not illegal. It is not prohibited. But our law discourages this form of transaction because it eliminates the income, and when the taxpayer eliminates the income, it also escapes the taxes that should have been paid by him. So those taxpayers who are non-dealers, who sell shares of stocks at a loss with an intention to incur a loss and later recover this loss by purchasing another identical stocks from the same issuing corporation, that is a wash sale. And there are guidelines on when or how taxpayer could deduct losses arising from wash sales. When a dealer of stocks incurs a loss, it is actually normal because it is part of his business. So if you are the taxpayer and you are engaged into selling of stocks, then any losses or any gains is actually normal in your business. So that is not a wash sale. But if you are a non-dealer of stocks and you incur a loss, so that could somehow be scrutinized whether it is a wash sale or not. Losses incurred by non-dealers of stocks becomes questionable, especially if he did so with the intention of reducing the tax. In such case, any loss claimed to have been sustained from any sale or other disposition of shares of stocks or securities shall not be deductible if the following conditions are present. So losses arising from wash sales are non-deductible. But we have rules on how much is deductible or how much is non-deductible. So first, the seller must not be a dealer in securities, because again, dealers in securities, they can incur loss, okay, and that is normal to their business. And the loss sustained is actual and does not merely arise from shrinkage of stock prices. So again, the loss is actually sustained, meaning this is not just a normal drop of the price, but the seller really sells the stocks to incur the loss, okay? Within a period of 30 days before the sale or 30 days after the sale, the seller either acquired by purchase or exchange stocks or securities which are identical to the stock or securities sold. So we can say that this transaction is a wash sale if 30 days before the sale or 30 days after the sale, the seller acquired by purchase or exchange any stocks or securities which are identical to those stocks he sold, or he has entered into a contract or option to reacquire a stock or to acquire stock or securities identical to the stocks or securities sold. So for example, if today is November 3 and then the taxpayer sold shares of stocks at a loss and the taxpayer is not a dealer in stocks, we will first look whether there are purchase transactions 30 days before that or 30 days after that. And we will consider if these purchases are identical stocks, meaning it is the same stock with the same rights, same feature, same percentage of voting. Those are identical stocks. Okay, we will consider whether there are purchases or contract of agreement to acquire identical stock within 30 days before that sale or 30 days after that sale. Okay, so let's have the illustration. A, not a dealer in securities, has the following transactions during the year. So on January 15, 2018, he purchased 5,000 shares of stocks at 12 pesos from ABC Corporation. Also on February 1, 2018, he purchased another 1,000 shares of stocks at 13 pesos each from ABC Corporation, and these 1,000 stocks are identical. Also, on February 28, 2018, he sold 1,800 shares from the first purchase at 10 pesos each. Also, on March 5, he purchased 800 stocks from this time it's XYZ company at 11 pesos each. So we know this is non-identical stocks because the issuing corporation is not the same. On March 17, 2018, he again purchased 500 identical shares from ABC Corporation at 11 pesos each. So we are asked how much is the deductible loss arising from the sale of stocks in February 28, 2018. So we are given that a taxpayer who is not a dealer sold 1,800 shares from the first purchase for 10 pesos each. So if we'll go back to the first purchase, the price was actually 12 pesos and he only sell these shares for 10 pesos. Therefore, there is a loss of 2 pesos each share, and that is 1,800 shares. So the loss would be 3,600 pesos, right? So we will first identify if 30 days before this date of sale, there was any purchase transaction of identical stocks. And we will also look whether 30 days after the sale, there were also transactions of or purchase transactions of identical shares. So the first thing to do is to compute the loss. If the problem is silent, which is not, as to what method is used, thus the first in, first out method shall be used by default. So since this problem specifies what shares are being sold, so we will apply the specific method. So the sale of 1,800 shares of stocks at 10 pesos, so the selling price in total is 18,000 pesos. And less the cost of each stock, which is 12 pesos purchased on January 15, 2018, and that is 21,600 pesos. So we have a loss on sale of 3,600. So before we can claim whether this is a deduction from our gross income, we will first identify whether this sale is a wash sale or not. To do so, we will illustrate the timeline of the transactions. So this is the timeline. This is January 15, 2018, where 5,000 stocks were acquired from ABC Corporation. And on February 1, 2018, there is another 1,000 shares of stocks from ABC Corporation, and these are identical stocks. On February 28, 2018, there was a sale of 1,800 stocks where the loss was sustained. That was 3,600. And there was another purchase from XYZ Corporation, which, as we know, this is non-identical stocks because the issuing corporation is not the same. So that was 800 stocks. And there was another purchase from ABC Corporation, identical stocks, 500 identical stocks. So we will identify whether there are shares acquired 30 days before the sale or 30 days after the sale. Okay? So we'll go backwards and we'll go onwards. So from February 28, 2018, we will count 30 days before that date. So that means on January 29 to February 27. This is 30 days before the sale or 30 days prior to the sale. And from February 28, we will count 30 days after the date of sale. So that would be March 1 to March 30. Okay? 30 days after the sale. So are there any purchases of identical stocks from January 29 to February 28? Or from March 1 to March 31? Yes, we have two. This one, the acquisition of 1,000 shares of stocks, identical stocks from ABC Corporation, this falls on the 30 days before the sale. And also, this acquisition of 500 identical stocks, this also falls on the 30 days after the date of sale. So, we have two acquisitions which falls within the 30-day or 61-day period. Okay? That is 30 days before and 30 days after plus 1, the date of sale. So therefore, this sale is really a wash sale. There was an intention to reduce, to eliminate the income by incurring a loss from the sale of shares of securities. So we will now allocate the loss, whether how much is deductible and how much is non-deductible. From there, we get a total acquisitions of identical stocks of 1,500. So therefore, there are a total of 1,500 identical stocks. Okay? After which, the computation of non-deductible loss is shown below. So the formula in computing non-deductible loss is equal to total identical stocks acquired over total shares sold times the loss. So any figure that we will arrive from that formula is non-deductible. Okay? So our total shares acquired, identical stocks acquired, was 1,500 and the total shares sold was 1,800 times the loss of 3,600 pesos. Therefore, the non-deductible loss is equal to 3,000 pesos. That 3,000 pesos cannot be deducted from our gross income because that loss is attributable to the wash sale. Okay? Thus, the only deductible loss is 600 pesos. That is 3,600 less 3,000 pesos. So again, we can only deduct 600 pesos. So always remember that when the number of identical stocks acquired is lower than the total shares sold, there is a possibility that there would be a deductible loss and non-deductible loss. Like in this case, the identical shares acquired was only 1,500, while the total number of shares sold was 1,800. Therefore, the shares acquired is lower than the shares sold. Hence, we have a portion for non-deductible and deductible loss. However, if the other way around, if the number of identical shares acquired is higher than the number of shares sold, for example, here is 3,000 and here is 2,000. Therefore, the identical stocks acquired is higher. So if in that case, the entire amount is non-deductible. Again, if the total identical stocks acquired is higher than the number of shares sold, the entire loss is non-deductible. Okay? So in this case, we have a deductible loss and we have a non-deductible loss. So this 600 will be deducted from our gross income, but this non-deductible loss will be capitalized. Okay? It will be added to the cost of the stocks purchased. And we have here, there are two acquisitions, the 1,000 and the 500. So we will allocate this loss, this non-deductible loss, to the two acquisitions. So the non-deductible loss shall be allocated and capitalized as follows. So for the acquisition or purchase of 1,000 shares at 13 pesos each share from ABC Corporation, this will be the formula. The capitalizable loss is equal to acquisition 1 over the total shares acquired times the non-deductible loss. So we have 1,000 over 1,500. So this is the first acquisition that falls on the 30-day period before the sale over the total shares sold under wash sale. So times the non-deductible loss of 3,000 pesos as what we have computed in our just a moment ago. So this proportion, this 2,000 pesos, will be added to the cost of each shares purchased at 13 pesos. Okay? By the way, this will not reflect in the accounting books. This will be reflected in the notes to financial statements. Remember that. In accounting, we do not record this. We will only record a memorandum entry, and this will be presented in the notes to financial statements. This will not be added or presented in the face of the balance sheet. Okay? So remember that. That's why there is really a difference between the accounting standards and in the tax code, and we will follow in this particular subject the tax code because we're discussing the tax code. On the other hand, for the purchase of 500 shares at 11 pesos, this will be our formula or computation. So acquisition 2 over total shares times non-deductible loss. So 500, this is the second one, divided by 1,500 shares times the 3,000 shares. So therefore, we will have a capitalizable cost of 1,000 pesos. So the 2,000 and 1,000 shall be added to the original acquisition cost of the shares. Okay, so that's it for wash sale. Now let's talk about abandonment losses. In the event a contract area where petroleum operations are taken is partially or wholly abandoned, all accumulated exploration and development expenditures pertaining thereto shall be allowed as deduction. So for example, if you are into petroleum operations, you will be digging the land to explore where are the gases or petroleums. You will spend millions or even billions to find and explore this petroleum and then realize that there is nothing in there. All those accumulated exploration and development expenditures could be deducted in full from our gross income if the petroleum operation is wholly or partially abandoned. So let us say you have a research and then it was said that in this particular area there are petroleum reserves, so you invest millions digging, exploring where in the areas the petroleum are located, and then realize that there's nothing, and you abandon the operation. Those amounts you spend in the exploration and development could be deducted as a deduction from the gross income in full. In the case of a producing well, which is subsequently abandoned, the unamortized cost thereof as well as the undepreciated cost of equipment directly used therein shall be allowed as deduction. So for example, there is a producing well. When you say producing well, there is something that produces the petroleum. Okay? It's it's positive, that's in there, but you abandoned that producing well despite the fact that it produces. So any unamortized cost as well as those equipment which are undepreciated, those also could be deducted as deduction from your gross income. Okay? However, if the abandoned well is re-entered and production is resumed or equipment is restored into service, the effects are, so before that, if after you have abandoned that producing well, later you realize that, okay, I must resume my operation because it might give me something as payback. So those amount that you have deducted from your gross income as abandonment losses, those will be recognized as income. Okay? The amount previously claimed as deduction shall be recognized as income. Again, tax benefit rule. Since in the year you abandoned that producing well, you recognized expense, you recognized deduction, therefore your gross income is reduced. Okay? You escape the payment of the tax because of that losses being claimed as deduction. So in the year you restore the operation or in the year you re-enter the production, then those losses previously claimed as deduction from your gross income will be recognized as an income in the year that you re-enter or restore the service or the operation. Okay? And such amount shall also be capitalized and amortized or depreciated as the case may be. Okay, so if you have undepreciated properties and you deduct the amount as deduction from your gross income for abandonment, then later subsequently you re-enter the operation, then those undepreciated properties will be recognized as income, at the same time depreciated in the following years. Okay? And finally, we'll discuss losses from gambling. You know already what is a gambling. Okay? It's a game. So actually, the losses on gambling are non-deductible. Losses arising from gambling cannot be deducted from the gross income of the business of any taxpayer. Because essentially, gambling losses are not part of the normal operation of the business, right? It is not ordinary. It is not necessary for business. Hence, they are non-deductible from the gross income. However, they could only be deducted from winnings if there is any winnings. Okay, so that's it. So losses from gambling can only be deducted from winnings. And when there is no winnings, therefore, there's nothing to deduct on your gross income. That's it. Thank you so much for watching. And I hope you watch the other videos that we have about itemized deduction. And if you like this video, give me a thumbs up. And if you're new to this channel, please subscribe, hit the notification bell so you will be notified whenever I will upload new videos. Thank you so much for watching and stay safe and dry.